Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us today, a former managing director at Goldman Sachs a little more than 10 years ago. She's turned into a fantastic author. Here's one of her latest books. It's called It Takes a Pillage. Now, this is a updated version of this book. It came out in 2009. This is a 2010 edition with a bunch of updated material. With us is Nomi Prins. Nomi Prins, thank you so much for joining us today.
Thanks so much for having me, Greg.
Well, I know I left off a lot of stuff off your resume. You've been on all the networks. You've written tons of articles. You're a senior fellow at Demos. I'm really glad to have you because in order to figure out what's going on in the world of finance, and I think it's the story of our times, people really need to have people like you. And I want to start off with one of your latest articles that you put on your blog, your nomiprins.com, that you can read for yourself. But you were talking about, first of all, let's talk about the debt ceiling and the budget battle. And you think that's going to get done. They're going to, bitch and whine and moan, and ultimately they'll raise the debt ceiling and they'll come up with something for some sort of budget. Will that hurt us in terms of the worldview of our, we can't even get, a long-term plan together, with bondholders and other people who may want to put money into the country?
I think a lot of how our long-term view is presented in the world has to do with timing. And in 2011, when there was all the initial debate about the debt ceiling and there was all this partisan squabbling and it was difficult and we got downgraded and S&P came on and said, you don't have your act together in Congress, so therefore we're going to downgrade you and question your debt. I think there's much less of that this time around. There's an equal amount of partisan squabbling, but there's also a little bit of distraction with Syria and other things to squabble about. So the debt ceiling itself, I think, will get raised. It has gotten raised every single time it's been up before Congress, whether it's a Republican Congress, a Democrat Congress, a Republican president, a Democrat president. It doesn't matter. It will get raised. And S&P, interestingly enough, in June preempted the fact that it doesn't even care what happens by saying that its outlook now for the rating of the United States, which they have at AA+, down from the original AAA, will effectively be now neutral from a negative watch. So they've already come in there and said it really doesn't matter what happens. We might have some comments, but it doesn't really matter right now.
That may have something to do with that $5 billion lawsuit that the Justice Department is putting against S&P too. Of course, that's probably just a coincidence.
It's coincidental that those guys are basically saying, okay, we back off your rating, whatever we did in the past, it's fine right now. If you don't get your act together, that's okay. We're good. Well, S&P, we're good on the United States rating right now.
Another thing you brought up in your article is all this leverage, this derivative leverage. I mean, J.P. Morgan Chase is $35 billion. They're hoarding, lots of cash, a couple $200, $300 billion in cash. And you say you wouldn't hoard if they were healthy, they wouldn't hoard cash. What do you mean by that?
Well, historically, there's always been a hoarding of cash at the biggest banks because they know what's really going on in the market. They know the flows. They know what their customers are doing or not doing. They know what's defaulting. They know what's delinquent. And however it is they present their books or mark their books to a Federal Reserve or to whomever they have to report, they really know what's going on. And the fact that J.P. Morgan Chase itself, which is the largest bank in the United States, is hoarding $345 billion worth of cash, which is historically high for that institution. They have $1.9 or $2 trillion worth of assets. It's a significant percentage, means they don't believe that things are really that healthy in their books, regardless of how they presented their last quarter financial reports. That's just a portending of things to come. In addition, they, of course, have massive derivatives positions relative to their assets, which have continued since the supposed regulation reform, the sweeping reform Obama and Tim Geithner talked about with the Dodd-Frank Act that was signed in 2010. So nothing has changed there. It's only kind of festering beneath the surface and beneath mounds of cheap money and other forms of subsidies that have come to Wall Street from Washington.
I'm glad you brought up the Dodd-Frank. You said that anything less than a exercise in political posturing, anything less than an exercise in political posturing and regulatory futility, no matter how many backpats accompany the procedure, that you started out this quote by saying, we need reform a la Glass-Steagall. Anything less is an exercise in political posturing and regulatory futility, no matter how many backpats accompany the procedure. In other words, we really haven't fixed anything at all.
No.
I mean, we're just as dangerously leveraged as we were before the crash in 2008.
I mean, if anything, we're more so because the concentration of our banks, as we know, the big banks have gotten bigger. JP Morgan took over Bear and so forth, and we just have a greater concentration of power of financial risk within fewer institutions that have been proven to receive financial subsidization from the Federal Reserve, from the Treasury Department, and from whoever administration is running Washington. So we're in a situation where there's more sort of what they call moral hazard, but there's more recklessness beneath the surface because they know they can get away with it, and they have in fact become more powerful and more concentrated than before the crisis. This is not what happened during the Great Depression. During the Great Depression, after the crash in 1929, which many historians and economists debate as to whether that was because of the banks or not, I fully believe it was. It was because of their practices, because of whoever controls the money, controls the practices, controls the risk. Risk happens, it's their fault. It's just the way it is. But at the time, there was a slapback of that form of risk. There was a separation, of deposits and loans, of people's money, from speculative investments, from securities creation, from all the other stuff on the investment banking side that banks were doing. Not only was there separation, the banks themselves, a few key bankers of that time, the head of Chase, the head of what was National Citibank, or has become Citigroup now, those two men had meetings with FDR because they wanted a separation. They preferred federal subsidization of their deposit base, their main customer base, against continuing to trade because they saw where it led to them. They wanted a more stable banking system. These guys running the show today could not care less. They've been proven to be able to get away with anything and have subsidies thrown at them no matter what.
Which brings me to my next point in your article, that the really scary thing, when you think 35 times, which is pretty scary, but Goldman Sachs has $133 billion in capital and $42 trillion in derivatives, basically bets. They have, to break that down, they have $133 to cover $42,000 in bets that may go sour. You don't have to have a lot of bets go sour for it that we'd have another AIG moment. Isn't that right?
No, absolutely not. What banks try to do is say that notional value of derivatives, those trillions and trillions of dollars that they are behind, are all hedged. They're all trades, they've got you divide them in two, half go one way, half go the other way, and everything's fine. But as we saw, as you mentioned with AIG, that's not what happens. All of these derivatives contracts have a chain of participants along the way. And what we saw with the latest crisis with AIG starting and Lehman starting and Bear Stearns' hedge funds going belly up because they had all sorts of convoluted CDOs and other forms of instruments that they were sitting on. They were all related to each other. So it's a complete, it's a circular domino effect. One falls, they all fall in a little circle that spirals bigger and bigger. And so any of these derivatives positions, whether they're considered hedged or not at any given moment, and that's if we believe what the banks say about them, does not account for any of these interdependencies, any of the relationships between the contracts, and therefore the risk is still inherent in the system. It's still a tremendous amount of risk relative to the amount of assets that a Goldman has and that even a JP Morgan Chase has. They have $2 trillion of assets and $70 trillion worth of derivatives exposure. There's a significant divergence there, and it's come down a teeny bit perhaps since the crisis, but only because of certain trade outs, not because of any regulatory authority or any desire to really fundamentally change their structure.
So let's move in right into today and what's going on last week with the president, talking about wanting a strike in Syria. Vladimir Putin, who wrote, and a lot of people were upset and up in arms and always insulting us in the New York Times. That wasn't his goal. I cannot believe in my heart of hearts that a former KGB guy is going to take his moment with an op-ed piece in the New York Times and just use it to go nana poo poo. Okay, I think the main thing he was asking, which was a plea, and his plea was, please don't bomb, because this is going to spread far beyond the Syrian borders, and that was the key phrase. That this is going to go far beyond doesn't mean just to Israel. Far beyond doesn't mean just to Turkey. I think far beyond means global. I think that's what he was hinting at. That this could turn into a real, excuse the French, but a real shitstorm.
I think he was. And actually, if I could just connect that to the point we just made, because I just thought of it, we're talking about derivatives having a chain. And it's really the same thing with what happens in terms of military action. It has a chain reaction if one area, if the U.S. goes into Syria. Putin was basically trying to say, look, there's no such thing as an isolated strike. There's no such thing as an isolated derivatives position, which is not what Putin was saying. But it's really the same thing. It's a policy of not looking at the bigger picture. And what Putin was doing, and of course he was taking his moment in the sun, as any good politician would try to do. He's also a politician, and sort of out-trumped Obama with respect to the political delivery of what he said. He's trying to say, look, one thing leads to another. It's really that simple. You go in and strike Syria. Yes, you bring in Israel, you bring in Iran. We get upset. There's more instability in a region that has immense instability right now. It has economic instability, it has political instability, and it's not a good maneuver. Think for a moment. And that is what he was saying. And to use, his term, Obama's term, American exceptionalism as a sort of excuse for that kind of combat doesn't negate the risk associated with it. And I think that was more of his point. And it's true.
Well, what would happen to the derivatives market if we had a strike? I mean, wouldn't and I'm not as nearly as educated on this subject as you, but I think that the derivative market could go haywire. It could go crazy. I mean, the whole economy could potentially implode if this thing gets way out of hand. That this isn't Grenada or Panama or even Libya. This is something that could really let loose the dogs of war. Couldn't the derivative market, couldn't the financial system just implode? Would they want that to happen as cover, saying, well, see, it was we only had a limited strike, but they started a bigger war? I mean, aren't we teetering? Isn't the financial system teetering on insolvency and could implode?
Well, the financial system has been, yes, teetering in insolvency for years, and the mega subsidizations, the trillions of dollars even still on the Fed's book subsidizing the prices of bonds and of mortgage securities, the ECB trillions that are subsidizing European banks, all of that stuff is keeping afloat a system that really by definition should be imploding financially, and it's not. So you put into that keg of Syria, yes, if it was an isolated strike, it takes a second, it comes out, but we've just discussed that that's highly unlikely. Because it's unlikely, what the markets tend to do, what the derivatives markets in particular tend to do, because they are more leveraged and their participants can act therefore more quickly on their decisions, is that they will probably overreact in a negative way, but that overreaction will and can foster tremendous losses. Credit spreads blowing up relative to the region. Before there was this talk of Syria, there was a lot of maneuvering of banks into the Middle East area. They screwed up the U.S., went to Europe, screwed up Europe. They're doing a little bit of dabbling in Latin America, in terms of finding opportunities and sucking out money and then sort of moving on. And very recently, there's been a lot of activity in the Middle East. Larry Summers was just off for Citigroup in Kuwait a few months ago talking about opportunities there in the geopolitical environment and so forth. And there's a lot more groundwork being done by Citigroup and JP Morgan Chase in Saudi Arabia in the last few years and so forth. So there's a lot of stuff going on in the region around Syria where banks and the financial institutions are putting themselves into position. So when there's more instability there, all of that newly created structure starts to implode first and then has a knock-on effect throughout the world. So that's the long answer. The short answer is yes, great instability there that is prolonged could cause havoc in the financial markets, particularly in the commodities markets and related derivatives markets. But there's also been a lot of initial maneuvering into that area that's going to get hit and have its own ramifications from a financial perspective.
So a strike could get out of control and implode the financial system?
It could implode, have serious ramifications on the financial system, starting from derivatives and sort of working on outward.
What are the prospects of bail-ins? We're going to have, some sort of people are going to be losing their money in banks. I mean, they just announced, the FDIC, that they'll no longer cover foreign banks past $250,000. Actually, no insurance at all in foreign banks. So they're kind of ratcheting back their insurance coverage. Does that tell you anything?
Well, that tells you they understand that the risk of future bank problems has not gone away and that they just don't have the money to accommodate. They're starting with foreign banks. The ECB just announced some language whereby they would have these bail-ins that supposedly 8% of any bailout that's necessary would be bailed in by in creditors or potentially depositors who have more than $100,000 in European banks. And they're sort of debating what the language of that is. But of course, the language is very, very loose. So it's like, but in certain circumstances that won't happen, and et cetera. So there's been discussion, more so than there has been in the United States. And on the back of that discussion and sort of weak language, the FDIC has come in and said, okay, well, you foreign banks, you're on your own. I don't think there's a danger yet of that happening here, just because politically it's going to be very difficult to make that happen, and the banks are going to fight it every step of the way, because this treads more on their territory. They just got all these subsidies; they don't want to really give them up, and they don't do math, and they don't care about the additional math of the FDIC being able to support their deposits or not. They say that they are healthy, the biggest banks. That is what they present. The fact that they are healthy on the back of all these subsidies is not something that they get into, nor does anyone in Washington appear to be getting into.
Well, I want to go back to the war question. Kyle Bass thinks ultimately, he says that, because of all the leverage and all the derivatives, and it's going to be trillions of dollars restructured, and millions of financially prudent savers will lose large percentages of their purchasing power at exactly the wrong time of their lives. And he says he believes war is inevitable. It's just an inevitable economic conclusion. Do you think war is inevitable here in the Middle East, World War III?
I hope it's not World War III, but it is inevitable that the United States appears to want to, that Obama appears to want to find some reason to begin with, what they define as various things that don't equate to the word war, but that would in fact unleash a potential war in that area. And it's a very dangerous area, and we shouldn't be doing that. We should be continuing to retract rather than continue to find new things to do there. Iraq wasn't good for our economy, certainly, or actually the Iraqi economy at this point, or was Afghanistan. Syria is not going to be any different, except for the fact that you have Russia on the other side, more ready to negate whatever effects we have here, and then you start a new Cold War. Is really what Obama's also dabbling on the edge of, and that's a dangerous position right now, more financially than anything else. So more again from this potential of derivatives and debt and financial infrastructure implosion, and then adding to that the loss of lives and anything that comes from military activity. So it's a tremendously dangerous time to be moving forward with aggression rather than moving backwards with diplomacy and connecting to that a reduction of therefore military risk and political risk from that standpoint, and also financial risk.
Martin Armstrong says that the stock market will double by 2015. What say you? Is that a good place to put your money?
I would not put my money in the stock market. Right now, it has had a tremendous run, and that has been because of the fact that interest rates have been at zero for the past 5 years. The most historically long period we've ever had that kind of interest rate policy in the history of our country. Through world wars, through everything else. Banks have had cheap money, therefore hedge funds have had cheap loans, therefore wealthier investors have been able to leverage themselves into the markets, and that's pushed the market up. It hasn't been a general population boosting of the markets. I would stay away from them, because I think that is flimsy ground. I believe the Fed will try to continue its policy of zero interest rate, and I believe that despite conversation to the contrary, it's going to continue some form of QE for a while, because every time someone, Bernanke says something that negates the potential of continuing to buy bonds to boost the markets and reduce interest rates, something happens, the market tanks, and he says, oh, I didn't mean it, or something gets backtracked, or there's an employment figure that he can say, oh, it's not so good yet, or whatever the case may be. I think that policy is going to continue. So I think that the market may creep along, but I think the greater risk is to the downside. The greater risk is to a real plummeting of the market when we notice that, for real, these banks aren't healthy, that they're fostering, artificial health on the back of federal subsidies is not true health, and that the market is buoyed by basically, sheer air.
Well, to one of your points about how the economy isn't doing so good, another signal, mortgage applications went down 13.5%. The 10-year Treasury is up to almost, in the 3% area from in the 1.6% area just, 3 or 4 months ago. So, that doesn't look good. When is the rest of the world going to say, even Vladimir Putin has said, was quoted recently saying that the money printing has to stop, and everybody knows it. And this is like around the G20 time over in St. Petersburg. When's the rest of the world going to say, yeah, I mean, all these bilateral trade agreements, in the Asia, they're not using the dollar, they're trying to get away from it. Everybody's trying to get away from the dollar. Of course, the Treasury market is a huge liquid market, but still, when is the rest of the world going to say, yeah, no, we're done. We don't want your dollars. Or we want a lot more of them to pay for what you're buying from us.
Well, that's it. I think the rest of the world, particularly Russia and China, have been trying to foster their own sort of financial communities. China's been doing a lot of more activity, for example, with Latin America. Russia's doing more activity with the Middle East and so forth, and trying to find their own sort of mini financial economies so that they can get away from the U.S. and away from the dollar. Now, Russia doesn't have this problem, but China happens to also hold a lot of treasury securities, as does Japan. So they're in this quandary where they don't really want our debt to be hit in price, because then the value of what they're holding will be reduced. So they're kind of in this situation where we want to develop other markets away from the U.S., and they are doing that. But the U.S. is so much a part of what they hold, and U.S. banks are so much a part of the financial markets globally and the derivatives markets. Our banks are 41% of all the derivatives in the world, that all of that, sort of being tread on lightly. I think that's where they want to go. But my guess as to how long it takes to get there would probably be longer than other people who want to say everybody's folding up, getting rid of the dollar, and sort of selling treasuries. I don't think that's going to happen as quickly as it should for economic reasons. I don't think it will for valuation reasons.
Well, how about gold? It got whacked last week again. A friend of mine at Greg Manarino says, hey, I think it's part of it is maybe some naked short selling. Of course, that's in there. He says, but I think some of it's real selling out of GLD. They're selling the paper and then turning it right around and they're buying the physical, and that the deliverable gold at COMEX is at historic lows. What's going on?
Well, I think gold is a perfect example of the difference between what's going on in a derivatives market and an ETF market and what's going on in a physical market, and the fact that we're in this odd period where there's been such a printing of money, such an increase in debt, anything that should relate to pushing the dollar down, pushing gold up, increasing inflation, and that's where the buyers came in. But it hasn't really happened yet, and that's because of this prevalence of the U.S. position in the world of bank position derivatives and all sort of codependencies that I was just talking about. It takes much longer for that inflation, which should be there, to go through, and for gold prices, which should be going higher and remaining higher, to do so. So you've got the trading around it. You've got all this sort of cash versus physical versus ETF versus derivatives trading, which kind of keeps it dampened. And then you have the fact that there's so much of a prevalence of subsidization for the U.S. financial position in the world that gold hasn't had the benefit of inflationary pushing that it should from an economic history and theoretical perspective, but it just hasn't translated into actual bolstering of the gold price.
Would you be a buyer here?
That's why again, same thing I'm buying the stock market. If this was a sensible period, if this was a period where Treasury's printing debt, Fed has a ridiculously large balance sheet, banks are in trouble, gold should be up. Inflation should be up, but it's almost like there's so much help on the other side to continue to bolster the banks, to continue to bolster the market, that it doesn't have the ability to get up. And then you add all the shenanigans behind it, and that's why I think gold is where it is.
Would you be a buyer of gold here? And A, and B, can't this blow up? I mean, can't these guys, they're just men. Can't this process, defying economic law? You can't defy economic law forever.
No, I agree, and that's been the question. I've said for the last few years, as have other people, that this can't go on forever. It shouldn't go on forever. It's not financially feasible. It's not economically feasible. And yet here we are, 5 years into it, and we have a market boosted by zero interest rates, by cheap money. Banks are floating on nothing, and it's continuing to be manufactured out of Washington. And the ECB has followed Washington's lead, has followed the Fed's lead, and done the same thing in Europe, where the economic situation is even worse in many countries than in the United States. And no, it can't continue to happen. But what will happen in the meantime is that the real economies, the job economies, that the prices of things will continue to work against anyone who's not running a bank or a large bank, anyone who's not sitting on a lot of information and derivatives positions in the right direction. And I think that's going to continue for a while. I think a war, as we said, could shake that up. Something has to come in from the outside to shake that up, because there's no logical reason why it has continued for this long. But the fact that it has means that it requires a much harsher external factor to really create that implosion that will happen, than simply the policies that are bolstering the market that are completely out of control and illogical.
And last question, you didn't answer because I asked you too many questions. Is the reason why. Sorry. Would you be a buyer of gold here?
Yeah, you did ask me, and I would not. Frankly, I would be on cash right now, because I believe there's going to be too much of a continuation of these policies that are illogical to begin with, that have had the effect of keeping the market up, keeping treasuries. Yes, the interest rate has creeped up, but for the most part, not too much, and has capped the inflation that the government measures, not the inflation that people have in their day-to-day lives or day-to-day expenses. And I think that's going to keep gold somewhat contained. So I would kind of stay out of it for right now.
Okay, Nomi Prins, this is your updated version of It Takes a Pillage. I love the takeoff on, Hillary Clinton's It Takes a Village. I love that. This is the updated 2010 version, a lot of new stuff in that. Your next book coming out is called All the President's Bankers, and it's about the relationship between big bankers and the presidents of the United States, both past and present. So good luck with that. It's coming out in February.
Yes, thank you very much. It was very insightful. I learned a lot from Panic in 1907, Teddy Roosevelt, all through Obama, and all the sort of secret relationships and alliances along the way with the bankers. It was you'll like it. It'll be eye-opening.
It comes out in February. Nomi Prins, of course, your website, NomiPrins.com. Thank you very much for joining us today on USAWatchdog.com.
Thank you, Greg.